Greetings and welcome to the Credit Union Evangelist channel. And I am yours truly, the Credit Union Evangelist, spreading the good news about CUs, or in other words, spreading the good news about credit unions. And I'm glad that you have taken this opportunity to join me in viewing this video on the topic, why is your money safer at credit unions? Well, let me first say this, and I believe I would be neglectful or remiss if I didn't pose this disclaimer. Let me say that banks and credit unions are both trusted financial institutions and are relatively secure. But in a moment, you will see that there are reasons why I believe that credit unions are considered a safer place for your money. Now, yes, I'm a credit union enthusiast, I'm a credit union advocate, so I may have a bit of bias. But I think in this video, after these few reasons that are mentioned, I think you would have a tendency to agree with me that credit unions are a safer place for your money. So let's go right into our presentation. Reason number one, the credit union member ownership and structure is quite different than that of banks. For instance, banks are publicly traded. They are for-profit institutions that are owned by shareholders, and banks' sole objective are to earn money via profits, and that's to reward their shareholders. Since dividend distributions can only come from net income, in other words, their profits, there's a motivation to significantly increase their revenue flow and or lower expenses. This motivation typically can influence their operations and their priorities for the bank in taking on, I would say, more risky investments. For example, I think you probably remember the 2008 financial crisis, otherwise known as the Great Recession. And during that time, we had quite a bit of banks, a lot of the large commercial banks that took on these risky investments called mortgage-backed securities. And there was a big to-do on how these packages of these securities were processed and put together, how there were these tranches and how these securities were sliced in a way that you really couldn't separate the individual mortgages that were securitized. And because there were bad junk mortgages put in with good mortgages, the whole security had to be written down. And as a result of that, you had some banks that failed. One of the bigger banks that comes to mind is Washington Mutual. They were, if not the largest, they were one of the largest holders of residential mortgages in the United States. And then there were other bank failures and mergers so that those banks that were in risk of being bankrupt and insolvent, they decided to merge rather than do that. Also, you had insurance companies. I believe AIG was a large insurance company that had invested in these risky investments. But for the most part, when you are motivated by profit, there's a tendency to take on more risk because you are promising your shareholders a greater rate of return. And that's pretty much the profit motive principle when it comes to for-profit banks and other institutions. Now, credit unions, on the other hand, we know that they are not for profit and they are member-owned financial institutions. Now, not for profit doesn't mean that credit unions don't seek profit, but it is not the primary purpose. As a matter of fact, the credit union model is not for profit, not for charity, but for service. And that is the primary focus. So when you look at this member owned, being that the members are the owners of the credit union cooperative, uh, the credit union is more focused on serving its members and their interests rather than maximizing profits. As a matter of fact, the distribution of the profits being not the driving force or the motivation that drives management, but instead, when these profits are realized, they are retained. And in some instances, they are passed down. I would say most instances, they are passed down for the benefit of the membership. And that manifests through lower interest rates on loans, or it may manifest as an increase in the savings rate of interest that is earned on savings deposits, or it may result in the elimination of certain fees, transactional fees, or it may be a combination of two or three at the same time, depending on what profit or the scope and size of the profit that are made in a given year. So this minimizes the need for credit unions to take on risk, to take on these risky investments. And that's why during the 2008 financial crisis or the Great Recession, credit unions were a safe harbor. As a matter of fact, when individuals saw that their deposits were in jeopardy in these large commercial banks, they decided to move their money out of those institutions and they parked them right in credit unions because they realized that it was a safe harbor. That's what we call safe banking. All right, let's look at another part of this member ownership and structure. Credit unions are also governed by a volunteer board of directors, typically comprised of members that will provide sort of a conservative, balanced approach to the operational goals of management, and that's by enacting sound investment and asset management policies. Unlike banks, credit unions' corporate governance structure is quite different than banks because banks typically are managed by C-suite professionals who have the ability to also sit on boards, and they have the ability to be on the board of the bank and at the same time serving as a CEO. As a matter of fact, it is quite normal for banks to have not just a CEO, but also a CEO that is the chairman of the board. And what that does, it gives the bank management greater sway regarding the corporation's policies and their operations. So in other words, banks then in control by their C-suite professionals, there is a greater likelihood that policy decisions will be established by those C-suite professionals who are also members of the board of directors. Credit unions, on the other hand, because their boards are member elected and member driven, they promote and represent the interests of the membership who elected them. This kind of governance structure is completely different, and it facilitates a shared authority between an independent board of directors, the management C-suite professionals, and to add another layer of shared authority, credit unions have what is called a supervisory committee. And that is usually a group of independently elected auditors. They are members and they have an audit function. And what they do is that they audit all of the credit union's operational and procedural matters. So we have this shared authority, so that not one group, which is vested usually in management, is controlling the institution. But this is a balanced approach. So when it comes to making decisions about risky investments, you then have a boards of directors that are able to, in some instances, push back on management to say no. The profits that you're seeking is not why this credit union was created, but it was created for the purpose of serving its membership. So that's reason one. Let's look at reason two. Well, credit unions and banks, they are both federally insured and they are both regulated by the federal government. And that kind of supports my initial disclaimer in the beginning when I acknowledge that, look, banks and credit unions are relatively trustworthy and secure. But I would give the edge to credit unions because credit unions, for reason number one, but we'll also look at reason number two, gives sort of support to why credit unions is a safe haven for your deposits. Now, both banks and credit unions are, as I mentioned, are federally insured. Banks are insured by the FDIC, which is the Federal Deposit Insurance Corporation, and credit unions are insured by the NCUA, and that's the National Credit Union Administration. Both insure deposits up to $250,000 for each depositor. So if you have an account at a particular bank, you have your deposit insured up to $250,000. If you're a member at a credit union, your deposits are insured up to $250,000. Now, if you have a joint account, let's say you have a married couple, their deposits will be insured up to $500,000 for joint accounts. This means that the government is ensuring and guaranteeing the safety of your deposits up to those dollar limits that I just mentioned. And that federal insurance, by having this in place, having deposits insured, it can kind of have a backstop for any bank or credit union that is threatened by a run. A run being that depositors feel that their bank is no longer solvent or has the capacity to keep operating. So what you'll have are depositors running on the bank or running on another financial institution. So the federal insurance guaranteeing deposits help to calm those fears. I don't know if you remember, since this is toward the holiday season, It's a Wonderful Life, and the Bailey Bank, in essence, had a run on it. And it was a situation where Jimmy Stewart, who was the Bailey that was running the bank, had to calm their fears to let them know that their deposits will be honored, and there would be no need for alarm. But in any event, the federal insurance helps to calm the nerves of the depositors. But aside from deposits being federally insured, banks and credit unions are federally regulated. But however, the difference is that banks have less restrictions with regard to their investment portfolios than credit unions, and they can make more risky decisions in the investments that they are permitted to purchase. Unlike credit unions, there are only certain investments. Credit unions can place their money, and that has a lot to do with the not-for-profit status, because credit unions have not-for-profit status and tax exemption because they provide a social good. And that social good is through service to its members. Banks, on the other hand, they're in business to make money. They're in business to earn profits. And that is the primary focus. So therefore, they are allowed to have more risk and to take on more risky investments. But the consequence of taking on more risk is the potential to take on greater losses. And for that reason, those deposits that are greater than the $250,000 or the $500,000 threshold that is guaranteed by the federal government, anything above that can be at risk. So if you have $1 million in the bank and 250,000 is guaranteed and insured, and the bank takes on risk that causes it to be insolvent, then your $750,000 that is on deposit is at risk of loss. And if the bank becomes bankrupt, then it goes through a bankruptcy procedure, and then creditors would have to be paid first, and then depositors would be paid a percentage. In other words, it would just be a big mess, and you would be out of your money. But when you look at credit unions who don't take on that much risk, but are very selective in the investments that it makes, because credit unions prefer to invest in their members. Because if the members flourish, then the credit union prospers. And that is that cyclical benefit, not only with the members, but also credit unions are community activists. And they believe in a holistic approach that if the communities are healthy in which their members reside, then that also adds a benefit to the members. That also increases financial wellness and well-being. So yes, banks are allowed to take on risky investments, but if things go wrong, your deposits that are above the threshold that is federally guaranteed, those funds will be at risk. Whereas credit unions who don't take on that much risk in terms of investments, your money will be secure. All right, let's look at reason number 3. And that has to do with member service or customer service and relations. Now, banks, especially the large ones, the commercial banks that you normally see advertised on television, those particular banks have a less personalized customer service. And that's because of the nature of the fact that they have a high volume of depositors. There are a lot of individuals that transact at these banks, and therefore the likelihood of bank personnel knowing you by name is slim to none. Now, you may have millions in the bank and your bank manager may know you, but for the average person of modest means, the average working class individual who may not have that type or sum of money on deposit, it is less of a likelihood that a bank would know you by your name. However, on the other hand, at a credit union, they will know your name because that is the personal touch that credit unions have. Credit unions have a sense of community. They have this philosophy of people helping people, putting people before profits, and that just creates a customer loyalty because the customer experience is enhanced. Credit unions have a high level of customer engagement. And then also, the deposit requirements of banks are much higher than credit unions. And in order to avoid service charges, banks have to charge a service fee. And on the other hand, credit unions, the deposit requirements are lower before a service fee on your account is incurred. Why? Because, as I mentioned before, the profits are typically retained and the benefits are passed down to the members in terms of lower interest rates on loans, higher interest rates on savings, and sometimes through the reduction or the elimination of fees like service fees on accounts. But when you're dealing with commercial banks, they have a certain high limit threshold where you would have to attain in order to get a reduced fee or an elimination of your service fee at all. So those are that's a difference with regard to member service and relations. Then also, when we're talking about the member experience or the customer experience, if you happen to contact your bank for whatever reason, I know personally when I was a customer at a bank, I would call and I would be speaking to someone in another country. Now, I'm not saying there's anything wrong with outsourcing, but there are impediments to the customer service relationship and experience by outsourcing your contact center. Whereas with credit unions, the contact centers are typically not just employees of the credit union, but those employees are also members and they are sourced right here in the United States. So there seems to be a communication bridge so that members are able to have conversations that are articulated so that if there's any concern or problems, the credit union representative is able to understand and to take care of their concerns. Then there are differences between how mortgages are serviced, which is part of the customer engagement and the customer experience. For example, a lot of banks, when they receive mortgages, which are pledges by the person purchasing a home, they pledge the property against a promissory note, and that is called a mortgage. It's a legal instrument that banks hold on to as the pledge that this promissory note will be paid, and if not, then the mortgage guarantees that not just the payments, but that the house, if you default, will be sold in order to fulfill the payment of the note. So what banks typically do, because they have to offload some of their risk, as I mentioned earlier, they take on a lot of risk. But when you're speaking of mortgages, it is not so much that a mortgage or property is risky, it's that the dollar amount along with the property, the cost, is a very high cost in the hundreds of thousands of dollars. So there has to be a certain ratio or proportion of asset quality. And in order for risk to be kept at a minimum. So what banks would do is that when they do loan the money and receive the mortgage as the pledge, they would then offload some of that risk because they need a certain amount of their money back for liquidity purposes, so that if you have their depositors that need to come and make withdrawals, that the money is available for the bank to do that. So what they would do is offload some of the risk by selling the mortgages to third parties, or they would engage a Wall Street firm if they don't have the capability themselves and package these mortgages to be sold as securities. That decreases their risk, but the drawback with regard to a customer service relationship is that you will be now serviced by a third party. So if the security is sold to an investor, there is usually a third party servicer that you then, as the holder of the property, the owner of the property, you would then have to talk with that third party servicer. Now, credit unions, on the other hand, don't necessarily sell their mortgages on the secondary market. And if they do, typically they sell it to Fannie Mae, which is a quasi-governmental authority that engages in or creates a secondary market so that the housing industry is free flowing. So they help to allow financial institutions to maintain liquidity by allowing the banks and credit unions to sell mortgages to Fannie Mae to free up the funds for liquidity purposes. But the difference is that when credit unions, if they do sell their mortgages to Fannie Mae, guess what? They still service their mortgages. In other words, you're not going to speak to a third party servicer even though the mortgage was sold. Even though Fannie Mae is the holder of the mortgage, the credit union can still retain the rights to service that mortgage. You're probably wondering, well, what is the importance of that? Well, sometimes, just like businesses have cycles, so do individuals. And you may have a member that is experiencing hard times, whether it's through a layoff, whether there's needed funds for an emergency, or there's a death in the family. There are things that life just brings us that we may not be expecting. And as a result, it may be present a difficulty keeping up with your mortgage. So rather than you speaking to a third party servicer that you have no connection with, the only privity or connection that you have is the mortgage itself and you making the payments, then there is no member engagement. You are not able to express the hardship that you are experiencing. But with a credit union who is servicing your mortgage, you are able to share those experiences. And in most cases, credit unions will work with you. They will create a forbearance program. They will establish a grace period so that if you fall on hard times, rather than having you default on your mortgage, your payments can even be restructured. There were those who lost their properties during hurricanes, but credit unions stepped in the gap and they helped these members to restructure their loans or allowing them to skip one or two payments without defaulting. And that's very important because we all experience hard times in our lives and difficulties. So in that regard, there are less opportunities for credit unions to have members that are defaulting. So then rather than writing down the mortgage and the credit union realizing a loss, by working with the member, it still allows the credit union to receive the mortgage payments, but just on a deferred basis. And what that does, it affects the bottom line. Because banks, on the other hand, although they have sold their mortgages, they likely sold it at a discount. And they are receiving their funds up front, but less than the amount of the principal that was created when the house was purchased and the money was borrowed. So these are just a few reasons why your money is safer in a credit union. Yes, banks are federally insured, federally regulated, and so are credit unions. But that credit union not-for-profit structure, member-owned structure, customer engagement and relationship, knowing that your mortgage is being serviced, that you can talk to your credit union, even when it comes to personal loans or automobile loans, when you feel that your credit may not be as strong as the next person, but your credit union is there in order to hear what other information you may provide. There are some credit unions that will accept your proof that you're a good tenant and that you pay your rent on time. That establishes credit worthiness. I'm sort of diverting off the original subject matter, but the point is that your money is definitely safer in a credit union. Well, hope the reasons that I gave kind of persuaded you to agree that your money is safer in a credit union. And I'm glad that you took the time out to watch this video presentation. And as I mentioned in my first inaugural presentation, that we will be having discussions like this and providing good content concerning credit unions. So for now, this is the Credit Union Evangelist signing off, still spreading the good news about CUs. Appreciate your time. God bless.